What's up guys, welcome to door number 12 of the finance calendar, where we dive into 24 financial ratios in 24 days. Don't forget to subscribe so you don't miss any of the ratios, and let's go! Yesterday we talked about the current ratio, so let's continue today with the quick ratio. The quick ratio is similar to the current ratio, and it tells us the company's ability to pay its short-term obligations. The difference between the current ratio and the quick ratio is that the current ratio was for obligations that are due within a year, while the quick ratio tells us the ability to pay obligations instantly. The quick ratio is calculated by subtracting inventory and prepaid expenses from current assets and dividing the result by current liabilities, or adding accounts receivable, market securities, and cash and equivalents and dividing the result by current liabilities. Let's take a look at an example. Let's use Intel as our example. You can find all the required values from the balance sheet. For the first quick ratio formula, Intel's inventory is $9.8 billion. Intel has no prepared expenses in its balance sheet. The current assets are $61.3 billion and the current liabilities are $29.6 billion. This means that the quick ratio is 1.74. For the second formula, we need to find all the assets that can be quickly converted into cash. Quick in this case means something like in a quarter, aka in 3 months. For Intel, it's all of these shown on the screen. These add up to $51.5 billion divided by the current liabilities of $29.6 billion, which is the quick ratio 1.74. So what does that mean? If the quick ratio is over 1, it means that the company is able to liquidate enough assets to pay all of its current liabilities immediately. If the quick ratio is less than 1, it means that the company might not be able to pay all of its current liabilities immediately. Because Intel's quick ratio is 1.74, it means that Intel could pay all of its current liabilities because they have $1.74 of liquid assets for every $1 of current liabilities. As always, you can use the quick ratio to compare different companies in a similar industry. A higher quick ratio means that company A would be able to pay its short-term obligations better than company B. However, higher isn't always better. In this case, company C might not be using their cash efficiently. Instead of investing it, they are just keeping it in the company. As always, use all the available information and ratios when making investment decisions. That's it for today's financial ratio. Hit the like button if you found this video helpful and subscribe so you don't miss the future ratios. Have a great day and I'll see you tomorrow. Bye.